Fundamentals of research. What is investing? Benjamin Graham defines investment in the following words. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Investment operations. Investing requires adequate efforts in terms of research and understanding the investment options available, determining their suitability for the needs of the investors and their appropriate value. Investing is not a one-time activity, but one that requires regular tracking, monitoring, and suitable changes to the investment decisions based on a new set of information and understanding. Thorough analysis. Buying shares of a company is equivalent to taking part ownership in a business. Indeed, buying a business is an alternative to starting a business and would demand the same kind of research and analysis as would be required when considering to start a business on various dimensions of the business. Safety of investment. In investments, this means investing in opportunities available at prices lower than their perceived value. Backed by strong research and monitoring, an investment portfolio should be able to protect an investor's investment value over a suitable investment horizon, despite short-term fluctuations in the market. Adequate return. The meaning of adequate probably means risk-adjusted return in comparison to other competing avenues for invested capital. It is important to understand the risk and return features of an investment before committing to it. Fundamental analysis. Equity earnings are not predefined, and equity is perpetual investment with no preset maturity date. The focus in equity valuation is on the future earnings and the estimates of growth in earnings. Profits in investments come from not only identifying a good investment option, but also making the investment at the right price. Fundamental analysis includes the following: economic analysis, industry analysis, company analysis. Top-down approach. Fundamental analysis may be triggered by changing macroeconomic factors, both international and national, such as GDP growth rates, inflation, interest rates, exchange rates, productivity, prices of commodities, regulatory aspects, and others. This can lead to an analysis of their impact on different industries and then to search to the best business in the industry. This is called a top-down approach. Bottom-up approach. Sometimes analysis is triggered by some news or piece of information on some company, which may move to industry analysis and then economic analysis to see whether broad industry and economic parameters favor the company. This is called the bottom-up approach to fundamental research. Technical analysis. Technical analysis is based on the assumption that all information that can affect the performance of a stock, company fundamentals, economic factors, and market sentiments is reflected already in its stock prices. Accordingly, technical analysts do not care to analyze the fundamentals of the business. Instead, the approach is to forecast the direction of prices through the study of patterns in historical market data, price, and volume. Understanding price behavior. There are three essential elements in understanding price behavior: the historic past prices providing indications of underlying trend and its direction, the volume of trading that accompanies price movements provides important inputs to the underlying strength of the trend, the time span over which price and volume are observed factors in impact of long-term factors that influence prices over a period of time, technical analysis and various trends. Technical analysis is a specialized stream in itself and involves study of various trends, upwards, downwards, or sideways, so that traders can benefit by trading in line with the trend. Identifying support and resistance levels, which represent points at which there is a lot of buying and selling interest respectively, and the implications on the price if a support or resistance level is broken, are important conclusions that are drawn from past price movements. Technical analysis and charts. Technical analysis converts the price and volume data into charts that represent the stock price movements over a period of time. Some of the charts used include line charts, bar charts, and candlestick charts. The patterns thrown up by the charts are used to identify trends, reversal of trends, and triggers for buying or selling a stock.